sorts of good stuff like that here today. So I'm Raghee Horner. Welcome to my office. I'm going to cut the live video of me off here in a moment, just so you guys have some nice big charts to focus on here. But if you're catching us live in the YouTube, again, thank you. Welcome every Monday. One of us will be here giving you a sample of what we do in the futures room with our amazing members. You guys will be hearing me read questions from both the live and the membership room. Happy Monday, everybody. Yeah, great to see everyone. All right, so what we're going to do, I'm just going to switch on over to the charts that we typically use and the notes that we typically keep. So this is how this works. Let me log into my notes. Let's see here. All right, so what I do along the left margin, this is for anyone who's new to the way in which we do our morning sessions. There'll be some notes kept on particular things that I'm watching for, setups that I will be taking. All those will be basically along the very left-hand side of this screen. The charts that I'm looking on will be on the other, 2/3, 3/4 of the screen. And just so you get an idea, I'm looking at 9 screens, and I'm looking at a lot of different markets. And then, the thing that looks most imminent for a potential setup, I will have on the screen in front of us. We'll start taking notes about what that potential setup can be. And that's how we operate here in the room in the mornings. So actually, for any time that I'm on the mic, I'm a big fan of keeping notes, not just for myself, but for you guys as well. So you can see we're going to go ahead and start our Monday notes here for March 29. All right. And so if you have to kind of slip in and out of the room and you miss a little bit of the conversation, don't worry about it, because you can just take a quick look at the notes and kind of see where the discussion is happening. All right. So let's do this. I'm going to go ahead and cut me out because, golly, we don't need that. There we go. So everything's nice and big for you guys on the live stream and in the futures room. All right. Great to see everyone. Do we have a special full moon coming? Is that today? I know the cat has been out of his mind. So yeah, heads up. We have a full moon, huh? Give me 1 second. All right. So let's see, the worm. Oh, it's the worm full moon. I got a question here about the review and the mastery. Okay. 1 moment here. All right. So, worm full moon. Wow. Like I said, the cat's been especially nuts the last few days. Okay. So let's see. I'm going to go ahead. Let's see. Hopefully if I can disconnect this camera, it's not going to do anything. Nope. I got to keep there we go. Okay, so everything should be good in the live stream. I was hoping to cut the video, but that's not going to work. It'll cut the audio too. All right, don't want that to happen. So let's go ahead and tackle some questions here before the bell rings. What will I be focused on this morning? Well, we know Friday's late day rally, and this always cracks me up. Algos are always the culprit on the way down, but no one ever says, "Oh, look at the algos on the way up." I really didn't take much of Friday's action into the close too seriously, because this is really important, gang. The market really didn't cross any significant thresholds in terms of where it went. Let me show you what I mean. And you might say, well, if we're going to do day trading, and that's not all we do, right? I mean, it's going to be a part of what I'll do in the morning. But take a look at the NQ. That was the candle there. Now, if you caught my free video, and everyone has access to that, if you caught my free video last week, we talked about this double Darvis support zone being a pretty good oversold zone. So in terms of the oversold long position, that was really the only thing that would make sense in the NAS. Yesterday, the rally that we say Friday, not yesterday, Friday, was really coming off that position. It wasn't even a great zone. It was just the only one that we had. And in CHOP, it's the only thing that makes sense. So I'm no more excited about, golly, I mean, a lot of folks got very excited as if confetti was falling out of the ceilings because we rallied into Friday's close. Really what needs to happen now, and notice we weren't gapping up. We're not trading above 13,000 or 12,988 and a half, which was the high. We're not trading above 13,000. We're not seeing a big gap on the morning. So really tough to say that in CHOP that move meant anything, right? And the NAS clearly wasn't the only market that rallied into the close. What about the S&P, Rog? Are you going to say the same thing about the S&P? I'm going to say the same thing about the S&P. Do we take out a recent swing high? No. We didn't even take out the value area high for 2021. We haven't taken out even near-term highs with today's candle. So the near-term high, Friday's high, 39.68. Today's current high, 39.64. It doesn't mean that I think we're just going to head back down. It means that until we take out 68, we're not really seeing a shift in the psychology necessary for me to say that Friday's close meant anything at all. All right. So let's see here. Let's see, gang. Let me get a quick audio check from both the rooms. From what I can tell, everything should be good in terms of sound and video. All right, the bell's going to ring here in about 1 minute. Excellent. All right, sound is good in the futures room. All right, cool. So let's go take a look at the Dow. Now, gang, the Dow has been the relative outperformer here. All right. The Dow has been the relative outperformer. So in terms of the way in which I would view the Dow, I didn't need Friday's rally to be bullish on the Dow. We did not need Friday's rally to say that pullback buys are going to make sense and there's a good amount of bullish conviction. The structure of the Dow is distinctly different from that of the Russell, the NASDAQ, and the S&P. It's significantly different. So Friday's rally, great, that's cool. It bounced off the wave, bounced off the 21 exponential moving average. But because of the double green structure of the Dow, we really did not need that rally. It's nice that it happened, really didn't need it. All right. So remember where, and this actually takes me back to a really good question from the Charts and Coffee this morning, which actually covered, hey, Rog, are we looking at, what was the question? Divergence. And I mentioned I don't use divergence because to me, it's actually not an effective way to look at indices before. I mean, if you get to divergence as a very last filter or very last indicator-based way to look at market structure, cool. But the fact of the matter is, you want to start at the sector level and get down to the heavyweight stocks, and then you'll understand why XLI is outperforming, right? Because take a look at XLI, industrials sector, and take a look at XLK. Remember, XLK is the NAS in many ways through the view of Apple and Microsoft. XLI is the industrials ETF within the Dow Industrials Average. Transports, again, a lot of times those of you that are fans of Dow theory like myself know that transports are oftentimes the leader, if you will. I don't believe in leading and lagging all the time, but Charles Dow would have said, watch the transports if you want to see where industrials are going. And I'm a big proponent of that. Hard to bet against the Dow with this kind of structure. Easy to not like the NASDAQ. And even in some ways, the S&P with this kind of structure and XLK. At the sector level, you can see why certain indices are outperforming. All right, so the bell is rung. I'm not in any rush. We're not like horses running off at the gate as soon as the shots fired. What we want to do is now take a look at the way in which the open's going to do a few things. Create a range. So we're going to watch the range. So after Friday's end of day rally, what's the mood of the market? Well, I think in a state, it's kind of meh. All right, we have a candle that's not taking out the highs of last Friday yet. We'll see how the market behaves. We will watch for V-score and HPMR lows. Those are buyable in this environment. I don't want to short the market. They are buyable. We are also looking for or tracking the range of the 9:30 to 10 o'clock clearing range. That's what it's known, clearing or opening range. Okay, so these are things that we're going to track for the next 30 minutes. The only setup that I'm really interested in is any kind of V-score low or HPMR low, which means the market's got to sell off, hit one of those volatility or volume-based lows during the clearing. Otherwise, we'll wait for the clearing range, and then we will look at the high-low of the range and potential breaches. Okay? Okay. Excellent. So it's what we do every morning. Is it an active style? Not even close. What are we waiting for? We're waiting for a true edge. Waiting for a true edge. What does that mean? I've either got the market tipping its hand, giving me a clearing range breach. I've either got the market giving me a nice low from which I can control risk as we test the volume or volatility low. Or ultimately, probably the most aggressive thing that we could have is if we get a trend. Now, frankly, we are getting a trend right now. We are getting a double green trend in the S&P, the NASDAQ, and the Dow. So let me show you what that looks like across all three of these. We'll start with the S&P. Double green, when I refer to double green, what I'm referring to is the structure of the 8, 13, and 21 exponential moving averages. And you'll see here, double green, double green. That's just giving me a very clear confirmation of bullishness. That's all that it is. Moving averages, price-based indicators, giving me a really clear sign of bullishness. So the levels we're sitting at are meh, okay, until price can take out Friday's high. That would be a significant, I think, an important level to establish some momentum above. In other words, the folks who bought into Friday's high, at that point, they're making money. Other people are going to notice we take out that high, and you'll get some momentum triggers, some stop orders likely as that happens. So Friday's high in that regard. So you might say, gosh, Ra, our daily time frame is pretty important in day trading. Yeah, I think they're really important in day trading. Okay, so as bullish as, say, the NASDAQ looks right now, remember, until we take out 988.5, this is really not that impressive. It's bullish. I'll take it, but it's not that impressive in terms of where we were last Friday as to where we are now here on Monday. All right, RTY, that is a yellow market. So you'll notice, okay, Rob, what does that mean? Right here, wave, sideways. What is the wave? It's the 34-period exponential moving average reading across the high-low close. And I separate the 8, 13, 21 from the 34 because this is more about sentiment and momentum. This one's more about the trend. And yes, we have some bullish sentiment and momentum, clearly, green grab candles, but we don't have a bullish trend. Okay, so RTY, not as bullish as YM, ES, and NQ. Jumping over to the YM, again, double green. This has been the strongest of the major indices. And I like when the Dow, S&P, and NAS move together. They do share a lot of common weighting. by way of the individual stocks and sectors that are within them. So again, when we're in a double green market, and even if and I think some of you might have noticed, especially those of you that are running the hourly price movement, this is that volatility support that I talked about. Some of you might notice that there's really no reason to short. Actually, there's very little reason to do anything in front of the bell. All right. So I know there's sometimes a bit of FOMO, and I think more active traders will say, well, Rog, what do you do with this? Nothing. There's not a darn thing I do with that right now. I will let the market find its range unless, again, it gives me a low from which I can buy off of, volatility or volume. I'm perfectly content sitting on the sidelines. Now, for those of you that are wondering, well, Rog, what about looking at the high and potentially fading that? Yeah, I will tell you, if you are looking at the top of this range saying, Rog, could that be a short? Yeah, it could be. Very aggressive, not my cup of tea, but it is something that can be viewed as a potential short zone. I will tell you that the probability of that is more about a retracement, maybe a quick move to the downside. Not that we're going to go from this green zone here down to the red, this red zone up here down to the green zone. That's not what it's indicating. Just indicates that there's some exhaustion up there. All right. That is all. That's really more ideally a target for a long than it is a short. But yes, if you were looking for some kind of fade, that's typically the zone. And it means that as long as you stay below basically 975, you've got a shot. Again, I won't take this. Not my cup of tea. But I'll at least point it out because I think some of you do want to be able to find some more two-way trading action, and that would be the way in which I would view that. So there should be a nice stall there. If nothing else, there should be a nice stall there. What about the S&P? Should we get a stall up in here? Yes, absolutely. Same idea. So what I'm trying to show you isn't necessarily, hey, I want you to short this, but some of you that have seen this before might get a pretty good idea of, okay, Ron, that could be a stall. The stall has to precede the reversal, right? You want to see a stall. You want to see a reason why the market might have a more difficult time continuing to climb higher. And in this case, we're talking about a value area high, volume derived level, and the HPMR red zone up there, which is a volatility derived level. Okay. And that all that could mean is the market's going to take a quick stall. It might retrace, but that's all that it is. It's resistance. That's all that it is. Doesn't mean that it's impenetrable. It's just resistance. So I wanted to take a moment to at least point that out because I think the markets are going to stall a little bit up in this area. Notice that it did at the very bottom of the range of that red zone, that HPMR resistance, and it's a lot stronger. It moved a little higher into the YM red zone, that HPMR resistance. All right. So this is where we may see a little bit of a stall. All right, that's all. The NAS is not, I don't believe the NAS is at its HPMR. Now, if this market were still yellow, in other words, the wave was indicating a non-trending market, it might be a little bit more tempting to say, hey, that could be a fade, right? It might be a little bit more tempting. But in a double green, I'm not super keen on that. I think we'll probably sell off a little bit, and then we'll likely find some support. And if the double green market's any indication of what's to come, it'll probably be the market gathering steam to continue higher, okay? What I'm trying to say is in a double green, while we might reach resistance, use that resistance to time a retracement buy, not a reversal short, okay? Two-way traders start to think about fading, and that's okay, but I'd rather you stick with the overall trend. And if you don't want to do anything before 10 o'clock, keep this in mind. Any trade that sets up and triggers before 10 a.m. is aggro. Why? Because we don't have a full picture of volatility quite yet. Okay? We don't have a full picture of volatility quite yet. All right. Next up is, hang on, again, let me take a look at some of the questions here popping up. Yeah, slow trader. Am I still using that March 8 HPMR? I am. I actually have on my on my to-do list to update it for tomorrow's session. I still think they're fine, but yeah, they're due for an update. So I'll update them tonight, and we'll have some fresh HPMRs for tomorrow. Yeah. All right. Next up. Question is, what is wave bullish? Srini is asking, what is wave bullish? Well, it's bullish, meaning I'm expecting higher highs. And the wave is the 34 EMA exponential moving average. That's what we're measuring for that. Okay? Using moving averages and their relationship to each other is really important. The relationship of moving averages to each other, I think, are a really powerful way to understand the structure of a trend. Okay. All right. So in the meanwhile, we have a 13.5 point range in the S&P. Let me show you what I mean by understanding the ranges. Let's go on over to Auto Chartist. And I'm going to show you some range numbers. Okay. This is the price movement range by hour of day. The column that I am interested in here is the 9 to 10 o'clock column, which is this one right there. And be nice if I pulled up the S&P. So let's go to that. All right, let's pull up ES. Okay, so when it comes to ES, what we're looking at is average 18, low end just under 13. Okay, so I want this market to at least trade above 13 points, but frankly, not over, say, 23. Okay, somewhere between 13 and 23 points is going to put us in that 68% probability. That's how we measure, quote unquote, normal or more predictive type price action. Okay, same thing on the NAS. All right, let me do it again and show you guys. 9 to 10 a.m. right in here. All right, so I want to see the NAS right about the high 60s, call it 68, 69 points. On average, about 90. But frankly, I don't want to see it go over about 115. So what would be great is at least around 69, 70 points. Average is 90. That's terrific. If we get there, and about, call it, no more than 115. No more than 115. So I want to see it stay below 115, but I want to see it above, say, 69, 70 points. That's going to tell me that we're kind of moving in a normal way. What is the S&P right now? 13. I'm sorry. What is the NASDAQ right now? 62.25 points. We have another 15 minutes to let this market, tack on a few more points, at least get to 70. At least that would be terrific. Above it would be even better. But right now, it sits at 62.25 points. All right. So it's a little bit below average, but we haven't really given it enough time to sort of put in its range yet. But keep that in mind. Those ranges are really important, gang. Narrow ranges make stop loss placement a little trickier because at any given time after 10, the market can suddenly start to expand its range and act more normally. And if the stops are placed on the volatility that was and not what typically is, a lot of times the market will stop you out and go in the direction of your trade. If the market's really, really wide, in other words, it's gone above the upper end of that hourly price movement range, then we know we've got a larger range, possibly an exhaustive range. And unless the market's just going to grind higher all day, usually that increases the probability that we'll stay stuck in a range, back and forth, back and forth, back and forth. Okay. Let's see here. Who is the first person who gets booted out of the the live stream today? All right, there he goes. Yet I don't know why these folks think we won't boot them out. Pushing Bitcoin. Pushing some phone number. Oh my gosh, really? Get out of here. All right. So Seth asked, do I have triggers set in my day trades like I do in sector secrets? Seth, sector secrets are usually longer term time frames. So yes, I do try to find triggers, but it moves so much quicker, right? So we don't, I'm looking at 1 minute time frames here. As much as I would love to give us a really good heads up, between 9:30 and 10, the best heads up that I can give us is, hey, let's wait for the market to trade to this level down in here on the V-score and this HPMR, which actually is going to overlay pretty decently, actually, because my V-score is coming up in here. You can kind of see that. And my HPMR is down in this area too. So that's gonna be at least a place you can say, well, when we start approaching, say, 39.43, would that be a zone to keep an eye on? So you're not completely out of the loop as far as what I would want to buy in the first 30 minutes of the morning based on volume and volatility exhaustion. But some things will be a little bit more, actually, I try to keep most of it with a decent shelf life. And on a 1 minute chart, if we have a shelf life of 3 to 5 minutes, that would be great. Okay. Do we have the HPMRs and labels for TradeStation? HPMRs, no. Some of the labels, yes. Some of the labels, yes. All right. So let's go back to where I was saying that we were getting rejected at the HPMR high on the Dow and S&P. So like I said, it's really a matter of a stall. And then we are creating a retracement because this is still a double green market, which means it's a trend, and weakness within the context of a trend is a pullback or a retracement. How about that S&P we're walking through? There's that HPMR. I mentioned that it could pull back. Again, I view that as a retracement. But those of you that are two-way traders could say, wow, that's a decent little move of about 7 points. That's fine. Exhaustion at their HPMR. Yeah, I don't necessarily think that's not a decent entry. And then some of you who are looking at, say, Ready, Aim, Fire or things of that nature might find that that level is a nice resistance level to the upside there. And when it corresponds, when a price indicator corresponds with that type of volume and volatility exhaustion, value area high, and HPMR high, yeah, that's a pretty powerful setup. If you're looking to trade both ways. Trade both ways means being open to both longs and shorts. I'm primarily looking for longs. All right. Next up is, tell you what, the crude oil market's been sinking lower and lower and lower. Crude oil in the next few days is going to be a really interesting market to watch. Oop, I didn't mean to do that to the chart. Let's try this again. Crude oil could be a really interesting market to watch in the coming days, mainly because, I love when Windows tries to be too helpful and wants to expand your chart for you. Gosh, that just bugs. Hang on. Let's see if I can get this a little bit larger here. I don't need your help, Windows. Quit being so darn helpful. I wish someone could tell me how to override that, because that just irritates. So I'm trying to expand this chart to just fill out the screen, and Windows wants to pull it across both my screens. Don't need that. Okay. Do not need it. Okay, so crude's been melting down, and crude oil's action over the next few days is going to be really interesting because we're coming up into an OPEC meeting where there's some expectation we could see an output increase, which would be bearish to crude. I'm excited for that possibility because, because I want to get long gasoline and crude on a pullback. And so gasoline probably more so. That's going to be a swing trade in the RB or in the UGA ETF. And then for those of you that understand that connection between the underlying commodity and the stocks that rely on that commodity, oil stocks and oil, you know that there could be some really nice pullback plays to be had on the XLE, OIH, XOP. So that could open up not just setups here in the futures room, but then also potential ETF and stock setups. Okay. Next is, and for those of you that are wondering, what am I waiting on for this breach? It's the first, again, 30 minutes of the morning, first 30 minutes. And then probably after we get some of our day trades in, sometime around 10:30, 10:45, we'll look at some of the potential swing trades, okay? I have to undo the snap feature. Oh, okay, Paul, thank you. I will find that. Yeah, bugs. I'll undo the snap feature. Thank you. Thank you. All right. Gold is not having a good morning. Hey there, Dan. Yeah, and neither should it be. You know, we've talked about gold in the futures room, and the preoccupation with it, I get it, is sort of a permanent thing. But those of you that have followed the way in which I recommend you guys watch gold has everything to do with real yields. You know, this constant blathering on about gold being a flight to safety and things like that just so missed the point. Gold has an inverse relationship to real yields. So when real yields are going higher, which we know they have been, we know gold is going to be under pressure and very likely go lower. And so those of you that are wondering, okay, Raghee, got it, but what the heck's a real yield? It's the nominal yield of a bond minus the rate of inflation. And if the yield of the bond is going up, right, and the Fed keeps saying inflation isn't, that chasm keeps getting wider and wider. Real yields are going higher. Gold will be under pressure. Okay, gold will be under pressure. So in some ways, can you say, well, Raghee, you tell me gold is somewhat inverse to bonds? Yes, don't forget to take that rate of inflation out of the equation. All right, hey, by the way, gang, let's go back on over to the NAS because it does seem to be heading down towards a potential V-score low. Let's jump on over there. And again, gang, just the sheer amount of just giddy silliness about Friday's rally, I really tried to drive home how misplaced that was. Again, the same folks who will say, oh, it's just in the machines driving things lower. It doesn't work the same way on the upside. Of course it does. So again, we want to be very skeptical of those kinds of moves, especially when they don't take the market anywhere new, right? There was nothing magical about the highs that were taken out on in the NAS. What was interesting, and you can check this out from last week in a free video where I basically highlighted where the oversold support was on the daily. That was a decent place to look at some QQQ calls. To get all giddy about a rally on Friday, please. Was that even, again, it wasn't even any technical levels that were taken out of any importance. So I really want to drive home. Don't let financial media sort of get you excited about something that really there wasn't any merit for. Okay, that's just total noob stuff right there. All right. So does the same real yield, hey, Iowa Brad, great question. Does the same real yield relationship apply to silver as it does gold? Not really. I mean, clearly we know that silver is going to have some relationship to gold as a precious metal. But what I usually recommend looking at silver as is caught between copper and gold. Manufacturing application like copper and gold to play on real yields. So it ends up in the middle. Although I will tell you, if you structurally look at silver, now I'm not talking about day trades here. If you structurally look at silver and you do so on a slightly longer term time frame, silver is far more interesting to me than gold. Silver's in a decent overall move on, say, a weekly. So yeah, this is a little bit more of a portfolio conversation, not a trade. But I would also say where we are on silver right now, take a look. Testing the 200 period exponential moving average, testing the value area low area for 2021. This is a potentially interesting, and not that we haven't been lower than this, clearly, but this is an interesting level where, for those of you that are wondering, hey, Rog, I know it's risky, it's choppy, but it is a yellow market, meaning it's sideways, and it is near a technical level, it's near a volume level in the right underlying market trend that would suggest this could be sold, right? This could be oversold. So then this could be an interesting place to look at potentially. It might be a little early. We might make slightly lower lows, but it might be an interesting place to price some SLV calls, because SLV will give you exposure to silver in a much more risk-contained way, and frankly, in a more affordable way. Okay, in a potentially more affordable way. So that would be an overnight type setup using SI to set up SLV. And you know what? Maybe we'll talk about that in the premium video today. I'm going to add that to my notes there. Jot that down. So yeah, silver could be interesting. It might be a little early, but it definitely could be interesting where it sits. And again, SLV would be the way that I would set that up. And in terms of SLV, I'd likely set that up in SLV via the probably the June 30s. The June 30s, okay? June 30 calls. 30 meaning June 30th expiration, I'd be looking at the calls. And then likely the at the monies, 22 and a halves. The 22 and a halves have a whole lot more open interest, but 22 to 22 and a half calls would be on the radar there for SLV. If you're curious, a little bit more specific at how I would look at that. All right, back on over to NQ. I completely distracted myself. Let me jump back on over here. Okay, so here we are getting really close. Now, there's something that has happened that I will typically warn folks away from this trade, or I'll tell you to play micros or minis. So we're in the HPMR zone. We're very close to the V-score. Haven't quite tagged it yet, but probably am very close. Notice this right here. We just went double red on the market structure. That is a problem, because what that does, it doesn't necessarily invalidate the buy. It just means that we're probably going to keep punching down to lower lows. It just means that placing a stop at this standard deviation, we've wandered so far from the mean, it's going to be far tougher. I'm not going to short this. It's still a buy, but the problem is we know that now we're likely to keep moving a little bit lower. So this is where a QQQ call would make a whole lot more sense. So how would you do that? You take a look at this. This is where I would day trade the QQQ. So the expiration for April 1 is fine. The April 1 expiration this Friday, plenty of liquidity there. And you would basically look at, say, the 313s or even the 312.5s. There are some 312.5s, but I think the 313s will give you more volume and open interest. And you would just basically look at the 313s, which right now are trading 382, sorry, correction, 382, 383 by 388. Okay. And so depending on which way the momentum is moving, you will be able to put your order near the bid and preferably get a fill. You might say, Rog, it's a 5, 6, 7 cent spread. I will not pay up. I am zero interested in paying the ask if the momentum is bearish. So that's how I would play this. It's a buy, but I'll go the QQQ route because, again, the stop is going to be far trickier because we've gone double red. My futures folks, you guys know what I mean by that. Micros are fine alternatives to those of you that are going strictly by the micros. Because we just need the lows are going to need a little bit more elasticity to place a buy from. The lows will need a little bit more elasticity. So this is a buy. This is a buy. If you're using ready, aim, fire, you'll probably notice that this is syncing up pretty nicely too. So V-score low, ready, aim, fire low, just barely broke that HPMR. When we went double red, do you notice what it did? Okay, I don't love this. I'm not saying we're out of the woods yet. We're not. We're not. But the way in which I will accommodate the volatility that I'm likely to see here before the market finds some bullishness, I will do so with a smaller position, either via micros, which is literally a smaller position in terms of contract size, or via the calls, okay, on QQQ. Now, some of you might say, well, Rod, I'm going to buy calls. Can I look to see if there's a setup on XLK, XLC, XLY, SMH, or something related to the NAS? Yeah, absolutely. XLC comes to mind for sure. It's yellow, second heaviest weighted sector within the NAS. XLC would come to mind. So you do the same thing on XLC. Problem is, there's very little volume on the options chain of XLC. So that's why we just end up not being able to go the XLC route. So you would have to find something slightly decently weighted within the XLC, like a Facebook or Google, as an alternative. And I usually just don't want to go there. Okay, I usually just don't want to go there. All right. So not my favorite because it went double red. What's the takeaway here? All right. NAS reached the V-score low with a double red. And that is a problem. So now I need to do what? Go micro or options or pass. That's not ideal. You don't want to fade lows with size in a double red environment. Okay, so that is the NAS. And as the NAS is moving lower, well, let's think about something else we can do. S&P. Well, the Dow is not flinching at all, is it? The Dow is actually staying pretty strong. And if the Dow is strong and the NAS is weak, actually the winner emerging from that is a pullback in the S&P. Unfortunately, the S&P did not give me the V-score low, but it did not go double red. Now remember the way in which the S&P is weighted. It's weighted in the first 5 stocks in terms of the names of the stocks, identical to the NASDAQ. It's going to be very sympathetic to the NAS, but it's going to be influenced by the Dow as well. So if the NAS is really weak and the Dow is really strong, and you see a pullback on the S&P, that's going to oftentimes be a really good proxy sometimes for the NAS. Behaves sort of NAS-like, but not exactly. All right. No, got very close to the V-score, which means, yeah, we're looking at a long. I'm sure not looking at a short, and it maintained the yellow, which means we're still in a sideways market where I could say this is oversold, not lower lows within the context of a trend, which is the problem we have on the NQ. All right, the other thing to mention is that my NASDAQ and my S&P just breached to the downside. All right, it doesn't mean that I can't buy them, but it does mean that I probably want to keep an eye on the Dow all that much more now. And secondarily, I want to keep an eye on the S&P. So YM is strong. All right, waiting for a breach. ES would be my next choice. Now, NQ is double red. So using ES as a proxy for NQ makes sense today. All right, that makes sense. So that is what so now what I'm waiting on is the market, is the Dow, this particular market, the YM, to take out 32,976. 32,976. I'm waiting for it to break higher through that level, and then we will start to look for the retreat. So as soon as that breach happens, I think it probably will, although we're not there yet. So, but once that happens, this shaded area here, that is the Fibonacci retracement zone of the clearing range high-low, and it's a really nice place to see pullbacks too. So that's what the retreat is. The breach, by the way, is taking out the resistance up here, 32,976, and the retreat is this, that zone right in there. And that's what we're waiting for. I don't have that working for me on the ES and NQ. We may on the RTY, too soon to tell, but that's definitely front and center on the Dow. All right. And these are mixed markets at this point. This is mixed. Why? S&P and NAS are weak. Dow is relatively speaking strong. And so it's easy to say, and we could have said this a while ago, but it's easy to say with a lot of confidence at 10:07 a.m., mixed markets today, which is not ideal. Mixed markets today. All right. So I think the only thing that even looks remotely interesting is maybe some V-score longs on the, so I want to prioritize V-score, maybe HPMR, right? We get down there, low buys in ES, not NQ. NQ is fine, but again, once it goes double red, not as good as a market that's maintaining the yellow, and that is our ES, which is going to be a little bit more sensitive to the relative strength we're seeing in the YM. So the ES lets us sort of trade the NAS without that double red problem. Okay. All right. So that is what we've got going on there. Okay, so now we're just going to wait a bit. Now we're just going to wait a minute. So let me do this here, gang. Give me just a moment. I'll be right back, and keep an eye on this V-score low here on the ES. I'll be right back. All right, gang. Thanks for that. Okay, so we are waiting for the V-score low in the S&P. And even more so than that, I want to prioritize a breach retreat in YM. So mixed markets, trying to take advantage of a V-score low. The best one that we had is a not so good NQ setup. Again, the double red lowers the probability of a nice clean bounce. It increases the probability of slightly lower lows. ES, I like where we are in the ES, generally speaking, for a potential bounce buy. Yellow underlying market trend, value area low, really close to the V-score, really close. So this is an interesting zone to look for a potential buy from. I just want to give you all a heads up. Where is the actual level for the V-score? It's sitting at about 38 and 3/4. So you're 2 points ahead of the actual V-score low. So that zone for a buy, let's say you're looking at a buy, as long as we, oh, did we just start to go double red? Darn it. All right, we'll see how it's starting to go double red there. But that zone is going to be closer to 38, 38 and 3/4. We just went double red. Maybe it won't keep, because sometimes it'll adjust back depending on price action affecting the moving averages, therefore affecting the JT multi-color bands that are down there. But that just went red. So that zone is the zone that the V-score suggests. We have wandered too far away. We're ready for some support, but going double red does to the same thing ES that it did to the NQ. Okay. But that zone is one, generally speaking, that I like for a potential buy. 38, 38 and 3/4. And it was what, 39, 38 and 3/4 and 39, 40 and 3/4. So that is a buyable zone. Just now, what are we going to do? What are we going to do? Probably segue to the micro, probably segue to, well, you guessed it, Raghee. Can we go to the SPY? Of course. Of course. So I would go out to the April 1. So Fridays, not April 1, sorry, April. Oh, wait, we have that. It is April 1 because of Good Friday. So it would be the April 1 Thursday expiration. And now we're looking at, this is for a day trade, so I'm not really expecting to hold it to Thursday. And I would look at what an at the money, which is going to be roughly that 393 is going to look like. And the SPY 393 is 348 by 350. Okay. 393 for April 1. So ES is, again, tricky because it's flirting with double red. I'd like it to lose that double red, and it might. Like I said, it might, depending on what price action does. It doesn't invalidate the buy. It just makes the stop a whole lot trickier. Does everyone get that? We're down at the V-score lows. We're down at the value area low for the morning. And I know I'm not going to short. I just know that the stop might be a little bit more like a trampoline, right? A little bit more elastic. It might give like one of those nets that are sitting below the high wire, right? It's going to give it's going to be a little bit more soft. It's got a soft level, not a solid level. Okay. Twitchy says the RTY might be setting up here. Oh, my RTY is doing something really similar, Twitchy. I was just looking at that on one of my screens here. And RTY hasn't breached to the downside, or has it? Because if it's breached to the downside, I don't want to see it go double red. It's flirting with it right now. So this would then be more of an IWM conversation, the micro. And gang, look how ugly this market is so far. Dow hasn't breached. It's 10:15 a.m. Eastern. NASDAQ is breached lower, but it does seem like it's attempting a bounce. The ES is being drug around by the NAS to the downside, but at the same time, it's not as weak as the NAS because the Dow is strong. All right. And you have the Russell that's breached to the downside too. So you have three bearish breaches. And one market that looks like it's strong, but it can't get above its clearing range high. So is that RTY potentially buyable? So this is the zone for the RTY that's not only hovering right there at the V-score low, it's reached the HPMR. So you would have to at least be open to buying all the way to 2193.9, 2194 with a stop below 2193, say 8, minimally. Okay, in other words, you need to place your stop just outside of the HPMR. But what have I mentioned? It's not that the buy is invalidated. The stop becomes much more difficult to place. When you have a stop that's difficult to place, for me, the best way to compensate for a more elastic market, because we have a buy in a double red, is go with the option. Go with the IWM calls. All right? Because what I'm saying is, even though I love my HPMR creation, okay, to place a stop just below that is probably going to get stopped out. I'm not saying it absolutely will. I will still look to build a long position in here, but I probably got to give the market a little bit more latitude to deal with that that sideways action that is hot. That's more likely because of this double red. So what's the best way to deal with the uncertainty of where the buyer is going to step in? Well, there's two things we can do. Let me show you one thing we can do here. Two things we can do. Look for volume. Look for volume. Are there any volume sort of ledges? I call them ledges because the volume that I put on the chart is this volume you see jutting out from the right. It almost looks like the side of a really wicked mountain. And so do I see any volume ledges down here? No, I actually see very little of anything that's helpful there, unfortunately. Yeah, that doesn't help one bit. So that's tricky. I don't have a ton of volume. In fact, we broke a ton of volume just to get down here. So it's kind of tricky. My MACD has gone negative, so I know momentum is moving against me. That's on a news flash. I've gone red on the 8/13/21 and then went red on the 34 EMA, but they're all just starting to line up now. So again, not that I can't buy. I'm only interested in the long, but I've got to do so with a smaller unit of minis, smaller number of minis, a smaller unit contract-wise, micros, or the IWM calls. Okay? IWM calls. Another thing I could reference would be, let's go back on over to our price movement ranges. What is the expected price movement range for the Russell right now? 21.93. So for those of you that are asking, Rog, where can I place a stop? I mean, I don't want to place it any closer than 21.93 even. This is 21.93.1. I don't want to place my stop any closer than 21.93 even. And I would say even 21, say 92.8 or something, just out of reach of that number. So what am I going back to? I'm not arbitrarily placing stops. I'm looking for volume. I'm looking for standard deviations of volume. I'm looking at in this case, I've moved on to volatility, historical volatility. Because what most traders will do is say, well, I'll risk 1 to make 5 or some arbitrary nonsense, which is what 90% of risk reward ratios are. All right, just some arbitrary, well, I'll risk X to make Y. Where do X and Y have any justification? We want to use volume and volatility to justify, well, why would we hang on? As opposed to not. Why would I hang on for 21.93? Well, it's the lower reaches of my volatility, and that's the minimum, gang. But I'd rather you just go with the IWM and risk minimally 15% of premium paid up to 25% of premium paid. Okay. All right. So. Gosh, what an ugly morning. I mean, I've got a couple buys here at the lower end of the ranges, but it's pretty hideous right now. Again, notice how that double red environment really puts pressure on buyers to work much harder to support price. The only place that I don't have double red is the ES and the YM. So you might say, Rog, should we just focus on the ES and YM? Yeah, probably makes a lot of sense. Okay. Now, I know a lot of folks are asking about that fund that blew up on Friday, gang. Look, I know there's a lot of concern about that, as well there should be. But let me just remind everybody of something that has nothing to do with that fund that a lot of bulls are going to say, see, would we be right except for that fund blowing up? Here's the thing, and it's almost like saying, hey, newsflash, Friday's rally did not really go anywhere. What does that mean? It's like my dog in the backyard. Adorable little thing that just runs back and forth within the confines of the yard, right? We need to do that to protect her, but I mean, she's just going back and forth in our yard. Well, is she going anywhere new? Well, we don't actually want her to, right? But she's just going back and forth. And that's kind of what price action is doing. So again, I was watching financial media and people are talking about, look at that end of the day rally. I'm thinking, what is wrong with folks who don't understand the confines with which the NAS and the S&P and the Russell are trading within? That move meant nothing. And I'm trying to say that as adamantly as I can, because it would break my heart. I know you guys in this room and anyone listening to my analysis knows, yeah, you'd look at Friday and go, good for you, Aldos, right? That's it. Rope a dope. You guys know what I'm saying? Rope a dope. That's what ended up happening there. Sadly. Okay. So a lot of folks, oh, this is the fund that blew up. No, Friday's move did not take us anywhere new. Okay. Now, I think it's going to exaggerate possibly the movement. Trisha asked me about, what is it? Archegos. I remember hearing something about this when I was watching Saturday Bloomberg. So the thing to remember is, yeah, you're going to probably see, chunks of this play hit the market. You're going to see some banks affected, clearly. All right. I think the bank that I heard the most about was Credit Suisse, which I have no exposure to. And let's also back it out. I'm long XLF in the Sector Secrets Mastery. Do I have exposure to Credit Suisse specifically there? No, I don't. Do I expect XLF to move lower? A little bit, but I don't expect it to get hammered, which it's not. So if you're thinking to yourself, gosh, Ragh, what if? Don't worry about it. Look at what it's actually doing. Look at what it's actually doing. And then think about the specific weight some of the banks have. So I think Goldman Sachs had some exposure, as did Morgan. Those are lower weighted stocks within the XLF. Goldman's going to impact the Dow in a more significant way. Morgan Stanley is actually pretty far down the list in terms of XLF, in terms of weighting. So this is where getting an understanding of who's at risk, what's the weighting, all right? So, and by the way, they were dumping shares last week, right? This isn't something that's just happening today. I think they were getting margin. I don't know the full story on this one, but I believe they were getting margin calls as early as last week. Okay, so they were getting margin calls. They couldn't meet the margin calls, and then they start to liquidate holdings to make up for that shortfall. Yes, for those of you that aren't. But I believe they're a family office too, with a lot of exposure to China, and I think Viacom CBS was part of that conversation. Discovery was part of that conversation. All right. And I've heard losses somewhere in the vicinity of 2 billion. But again, I'm not on top of this. I just remember some of the little sound bites that I heard on Bloomberg on Saturday or Sunday or whenever it was that I looked at this. They annihilated the Asian markets, though. If you take a look at what happened, I think in the Asian markets, like Nomura, got hit really hard. So for those of you that are asking me about that and wondering how much does that have to do with this, I think the move today, or at least the stall today, was inevitable. But this might be adding a little bit more bearishness to that. And then as far as the exposure goes, this is where, 13Fs are what you'd have to. Again, I don't know the full exposure, the fallout. I really don't know. Okay. The full exposure in terms of the fallout. I do know these folks used a lot of swaps as most of these situations happen. In other words, they were over-leveraged knuckleheads. It's almost every time. When you look at these culprits, is it the market? No, it's these knuckleheads that are over-leveraged. It's the long-term capital management story all over again. Guys who think they're too cool for school, they operate under the new math, they over-leverage, and then whoopsie, value at risk becomes too high. And everything implodes. All right. So, yeah, kind of a slow morning here, gang. I'm waiting for my pitch. NQ has recently gone yellow. That means the V-score lows are back in play, but it doesn't mean that we won't go double red again. Again, all we were looking at is some QQQ. So for those of you that are wondering, okay, Rag, if I scooped up those QQQs, all right, I'm just kind of following along today, not necessarily jumping in, but I just kind of want to follow along with you. All right, so just out of curiosity, my futures folks, did anyone take a look at the QQQ, the at the money QQQs, 312 and a halves? Yeah, what did you guys pay? And I ask you guys this because I would like everyone else to get an idea of what it costs. And so I think to pick those up around 380 was probably realistic. Yeah, Mike, SRG, you got a killer fill at 370. So you guys bought those 312 and a halves, which would have been at the money, slightly in at the time, right? Right, 312. Or do you guys look at the 313s? 313 would be fine too, but the 312 and a half, yeah, they were those 312 and a halves were trading 383 by 388, and you could split that bid offer. In other words, don't pay 388, but maybe you offer 385, 384, right? You split the bid offer. So you're at the top of the line of the people who want to be buyers, but you're not giving the sellers what they want. All right. Yeah, 380 was pretty realistic for those 312s. Yeah, I agree. Okay. And you can do a call spread. Sure, you can do a call spread. Sure. And then so the question becomes, all right, Rog, what's the risk on that? So let me just show you 380. I think the first place you want to calculate is a 15% drawdown. So about 57 cents. And the second number you want to calculate is a 25% drawdown. And that would be my threshold for this. So we're not necessarily using the underlying price as a sole determining factor of whether or not we're able to stay in this trade or not. We're actually using a value in terms of premium paid. So somewhere between 57 and 95 cents. Now somebody might say 95 cents? Rog, I bought a bunch of these. I don't know that I want to risk 95 cents. Then fine. Go with 15%, go with 20. Just use a premium-based threshold in lieu of a hard price-based stop on the chart. Because again, in a double red, that becomes far more difficult. Right? And then we also know that the SPY, we had a similar conversation. Let's if we want to scoop in and play the ES, we can look at the SPY. Again, I don't love this, but I'd rather the Dow have breached, but even that's rolling over right now. So again, I think Friday's rally into the close was absolute rubbish. It's a sucker's rally. People got entirely too excited about it. It did not carry the market anywhere significant in terms of taking out new swing highs. That's the litmus test, gang. Don't get suckered into, oh my gosh, what a great close. Did it take the market through significant price, therefore psychological thresholds that would have led to a little bit more optimism on Monday? Now you might say, no, Rog, and then we got this hedge fund news. Yeah, I'm with you there. So it was a double whammy in many ways to the markets to not have crossed significant thresholds on Friday's rally. And then you've got this hedge fund implosion news. I don't know why people think the guys who run these things are so smart. I can tell you firsthand, they're not. They're just better capitalized than you and I. And then when you saw in the GameStop shenanigans, they also have, but I don't know, do you have buddies that you guys can call and borrow $2 billion from? I don't. Yeah, I guess I need new friends. Hey, I was over leveraged on GameStop and a bunch of Reddit kids just absolutely rocked my portfolio. Yeah, I know it was over leveraged. Sorry, yeah. I owe you dinner. Can you loan me $2 billion? Exactly. So I don't know why people think these people are so smart. They're not. I've talked to far too many of them. Are there some that are? Yeah, I'm not going to say they're not. But this kind of status we give them as market gods is so unwarranted. I respect retail traders far more. someone who's got their own money on the line, making decisions on their own, who can't call people up every time they blow up. And then you've got the banks where, good for them, too big to fail is a thing. No one comes bailing us out. Yeah, $2 billion, right? What a phone call. How does that phone call even begin? All right, gang. So let's see. Dow did not breach, but it's still hanging in there. I don't have enough bearish momentum to short into. Although RTY is looking pretty darn ugly. So for those of you that are wondering, Rog, will you short this? I will not. I will not. I'd rather be flat or have a handful of options in the market to the long side than short this. I have right now still a standing long only approach, but for the most part, I'll take a couple small positions with some options, risk maybe 15% if anything. And if at the end of today I'm pretty much short, it's kind of an ugly morning, right? Rope-a-dope into Friday's close, this hedge fund, and then now just these really ugly mixed markets. The other thing that I will say, again, just in light of at least touching on the topic of two-way trading, your Russell's gone full on double red. That is a short the rally swing short. In other words, if the market rallies into the 13 or 21 exponential or even into the wave, if you are looking to short, double red's where you can do it. Double red is where you can do it. So small caps are getting annihilated here, which has kind of been a constant. Although those of you in the futures room know I don't love the Russell. It's weighted completely different than the ES and QYM sectors at the stock level, weighted completely different. What else do we have here? Let's tackle some questions here. Just kind of I was hoping for a little bit more interesting a morning. What I thought we might see, what I was hoping for from Friday, barring this hedge fund news, which quite frankly might be a little bit bigger than I even wanted to think it might be. I think by now we'd be pretty used to over leverage hedge funds doing stupid things. I guess not, but whenever they liquidate their positions, clearly that's going to, be pressure on the market. But what I was really hoping for was that we would see a little bit of fading from Friday's rally, and then we could scoop up some V-score lows. So what I wanted to see was some weakness at the open, and then we'd scoop up some lows. And it looked promising at first, but the lows and the weakness really hasn't turned the corner. And that's where, again, some of this hedge fund news could be more impactful. But I'm still a fan of looking at the long side. Because you know what's bigger than a hedge fund imploding? Jerome Powell and the printers. And I got to tell you, gang, one of the things that Bloomberg, I think it was Bloomberg, was talking about was that, look, gang, not everyone's going to have exposure to this, what is it, Archegos, or I don't even know how you pronounce it. This Archegos thing. Not everyone's going to have exposure. I don't think it's that broad. Now, sometimes just the news, the chatter about this thing can actually be more damaging than the actual unwinding. Like I said, they've been unwinding since last week. So long and long only, gang. Long and long only. I think a little bit too much might be made of that Archegos, but we'll see what happens. All right, next up is, bear with me here, gang. I'll tell you what, I'm very interested in what we're going to see out of the European close. We talk about the Bermuda Triangle here in this room quite a bit. I'm very interested in seeing what happens with this European close. I'm still, look, as weak as this morning's been, when you take a look at the Dow, it still hasn't given up. The ES also has not given up. Neither have broken their V-score lows. Clearly, NQ has been weak. It's been a lot more tricky. Let me show you what you want to avoid. Okay, this is probably more important. You want to avoid prolonged double red, like we see here, red, right? Red. You want to avoid prolonged double red with the break of the V-score. See, we're down below the V-score low for the morning. That's, for the most part, what I want to avoid. Let me show you what the next worst would look like and what the difference is. Here's the NAS. We never broke the V-score low. We had some exposure in double red, but notice what the Russell did. It broke the V-score. It went beyond the low, the standard deviation, the low of the morning, and it stayed double red. This was double red, but it never broke the V-score. Do you see the difference? These little nuances make a difference, gang. To know, okay, that's something I want to avoid. This is something that might be tricky in QQQs. So those of you with the QQQ calls, or if you bought the micros, do you notice how you were able to sit through the noise? Everybody with me so far? I know I'm rocking two rooms here, and my apologies if I'm not getting to the questions as quick as the other, but does everyone understand why I say, look, don't short the market down there, but just find a way to position size accordingly to take a little bit more lower load, a little bit more noise, a little bit more elasticity before the V-score does its thing, which is the higher probability side of this is that it moves higher. Does everyone see how using the QQQ, using the micro gave you that sort of ability to sit through it? Does that make sense? Okay. And then also why the S&P would be also another place to keep a close eye on as long as the Dow remains a relative outperformer, because the S&P is going to move with the NAS, but it's also going to be, in this case, further buoyed by the Dow not having breached lower. The Dow got tantalizingly close to the HPMR. Oh, I was watching that really closely. It would not have been an HPMR and V-score low until it broke just below the HPMR, but got very close to that HPMR. The problem is the V-score low would have us somewhere probably around, 760, maybe 755 before that kicked in. Who knows? We still might get it. Who knows? But I would position size quite small, scale in. Remember, these lows are going to be pretty elastic. And yeah, it's just kind of an ugly morning. Let's see. Hey there, Kelly D. You think that a big container ship, the size of the Empire State Building, getting freed would be a bigger deal after 6 days, right? I don't know that it's actually out of the way, though, Kelly. I would have to think being lodged into the bank that way for 6 days has got to damage the hull. No, I haven't really watched that. Although I'm sad that all those hilarious memes will be done. It is free. Oh wow. Okay. Well, finally, wow. You realize how the size of that ship is just mind-boggling. Just mind-boggling. Okay. In terms of follow through to the upside, gang, one thing I'm watching. Oh, you know what might be interesting to watch here? I'm seeing it sort of on the NQ and YM right now, and that's our little 1, 2, 3. Okay. That's our little 1, 2, 3. So let me show you guys an image of that. So you have something to work with here. What a 1, 2, 3 looks like. It's a very old pattern credited to Charles Dow. Let me show you why we credit it to Charles Dow. All right, so this is your Dow theory definition, basically, uptrends and downtrends. All right, so what happens with a 1, 2, 3 is we get that lower low, higher high, or swing high, higher low. Again, can't take that lower low out, and then that's the beginning of an uptrend. That's your Dow theory look. But look at the pattern that emerges while that's happening, which is why it's credited as being a Dow 1, 2, 3. Boom, boom, boom. Right? Lower low, higher high, higher low. I look at it as a lower low, swing high, retracement. I like this 3-point to be at least 382 to 50%, even to 618. It could be a double bottom too. You can create a double bottom here. There's nothing wrong with a double bottom, but I like that number 3-point to be a retracement of some Fibonacci significance between 1 and 2. But that's why it's credited to Charles Dow, which rightfully it is, because you can see how the beginning of the uptrend begins with this cute little pattern. So here's another look at that pattern, another little bit more clear look. All right. Now, does that start to emerge a little bit more clearly? Now, this doesn't have to be a daily time frame trend reversal, although it can, but it can also be intraday. So if, let's say, the Dow was to give us a 1, 2, 3, this is now sort of using it a little bit different. Here's your lower low. There's your swing high. This cannot go lower. This whatever this retracement is going to be, it could be a double bottom, but it can't go lower than this. And then what you're waiting for is a breach through this swing high, which in this case is accompanying the vicinity of the wave. So there's a lot that has to happen to validate this. Right? I'd love to see it stop at, say, 820. All right, let's put a deep 3-point in there, but not a lower low. And then when it comes back up, that would be the reversal intraday, right? It's kind of taking that Dow theory conversation and applying it to a shorter term time frame, but it's a similar idea. I don't know that Dow ever imagined we'd be looking at 1-minute charts doing this, but the pattern is the pattern. The pattern is the pattern. So it cannot take out that lower low. It cannot take out that lower low. Now, what would be even nicer is if that were occurring in some kind of 15 or 30-minute uptrend, right? I might be asking too much for that. A slightly longer term time frame, if it had bullish structure, which we're just not getting that, but that would be even nicer. Okay, let's see. The volatility squares, yeah, that's called the HPMR, Dr. VWAP. I like the name. Yeah, they're in the room drive. They're in the room drive for Thinkorswim. All right. Next question is, all right. Let me get on over to the live stream here and grab some questions. All right. So we're focusing on some day trades here, gang. If we have some time, which we should, we can take a look at some longer term setups and conversations. Sure. So one of the questions earlier, and I know it had scrolled by much earlier this morning, was about larger tech holders from the 13F filings showing that they're unwinding their positions. Look, I don't know that I need to look at a 13F to know that the NASDAQ on the daily is really a dumpster fire. One of the things that I've been talking about as clearly as possible, if not practically pleading people to do, is stay the heck away from the NAS. So if you follow any of my work in the free videos, right? Not even the paid. If you follow my work in the free videos, you know I've been basically saying, gosh, of all the things on earth to trade, why the preoccupation with the NAS? It's just so misplaced. And the folks who are doing it, I would imagine, because I'm not, we're not doing it in the Sector Secrets. We're not doing it in this room. The last swing by we even discussed was potentially the Dow, not the NAS. This thing is just hideous. Where are you going to find an edge in the Dow? Almost everywhere. XLY, IYT, individual names. S&P is a little bit better when you focus in on things like the financials. And the NAS, the only thing that looks even reasonable is the XLC. And it looks like XLC was hit hard by the 1-2 punch of Facebook selling off in front of the Capitol Hill testimony. And then now this VIAC news with this chucklehead hedge fund. It's just been tough to want to even engage the NAS. Even finding relative outperformers is difficult. What do I mean by that? Take the NASDAQ and acknowledge what it is. It's a big group of stocks. And then even further, it's a big group of stocks organized by sector. And that's at the heart of Sector Secrets, okay? The mastery that I do. So I look at the broader index, I look at the individual sectors, I look at the individual stocks. And when you do that to the NAS, there's not a lot to like. There's not a lot to like at all. And I can tell you, momentum traders are getting absolutely Donkey Kong today because a lot of times the type of chop and rallies and sell-offs you get within chop tend to trigger momentum traders. You don't want to do that. Even momentum traders do better in a trend, right? Trend followers like myself do better in a trend. Momentum traders do better in a trend. Just everything's more predictable, specifically in an uptrend, right? So you want to prioritize those as much as possible. All right. Yeah, and we'll transition to some longer term play conversations here in a little bit. Probably what I'll do here around 11 is we'll take another little break. I'll give you guys a quick break. Yeah, my throat's been, I don't know what, just worn out the last couple of weeks or so. So I'm going to give myself a quick little break. I know some of you have been listening to me now for 2 hours. That's a lot. Kudos to you guys. All right, morning vitamins taken. All right, so we'll take a quick break, and then when we come back, I'll be happy to take a look at some longer term questions also and some Q&A. But let's take a little bit more now as we go here. Do I like the Looney? Hey there, Mark. Yeah, 6C is one that we've been talking about quite a lot in the futures room. It's probably the best look at a US dollar short that there is. I still like the short on the dollar. I'm not really rushing into it right now because, the problem is we're still seeing more weakness on the euro, which means we're still going to see more strength in the dollar. And of all the things that I could trade, and this might be, a really good heads up to those of you that are in the futures room and in the Sector Secrets Mastery. I mean, we're gonna look at some watch list rebuilding, but I think it's really important to look at what we did in March that was so distinctly different than what I had done in January and February. And that was to get even more granular and more uncorrelated from the indices in March. I mean, that's why we had a good March, actually a arguably great March. And it was the way in which we redirected. So we're going to watch list build, but I think the best way to watch this rebuild is put March into context. So we'll do a recap of March, which is going to really organically lead us into doing more of the same in April, but with a different set of uncorrelated and sort of reflation-oriented stocks. And so things that I have been trading happily, like the 6B, some of these, especially with the dollar move, this may not make the cut for April. There's a lot of things that won't make the cut for April. The process will remain identical. What we did in March worked. The process will remain the same, but the group of stocks, like you'll notice, Freeport-McMoRan, Donkey Konged, RIG got absolutely thumped. There are some names that are not going to make it because the stock structure, the market trend structure changed. But the process that got us to those in the first place, and Freeport, McMoran, and Rig were great winners before they got stopped out, right? So, it was upon the re-entries that at some point the trend just finally broke, and that was that. But the way in which we landed upon those names like CCJ and things like that, yeah, we're gonna go back to that same process. So we'll definitely be reviewing that this afternoon when I see you guys at 3. All right. Peter asked, do I provide the labels and HPMR? Oh yeah, we talked about that. Sorry. Yes. Whatever I make available as far as free indicators, Peter, I put in the room drive for the futures folks so they can download whatever they want for the platform that they have. How do I gauge trend reversals using the V-score? I don't really look at it as a trend reversal tool. Thank you for the question. I look at more as a tool that suggests where support and resistance could be, not necessarily a trend reversal. For trend reversals, I think I can use that 1, 2, 3 pattern and the wave. Yeah. Okay. So, and yes, thank you for the advice on the snap windows disabling. I got to figure that out. I will. Oh, thanks for being on today, Raghee. No, my pleasure. We're going to be doing this every Monday. So someone will be on the air every Monday, taking you guys through a little sample of what we do in the futures room. So hopefully it's helpful. JP Morgan, Nikolai. Yeah, so that's an interesting question. JP Morgan takes us through a number of realities. JP Morgan takes us through the S&P because financials are heavily weighted within the S&P. JP Morgan then takes us into the XLF. And of course, the stock itself and the other heavily weighted names within the XLF. One of the things that I recommended last week, because again, all my cards on the table, we're long XLF in the mastery. So is it going to hold a little bit better than other sectors? I do believe it will. Is it going to be a name that we can continue to focus alongside on? Absolutely, double green. And one of the reasons I went XLF as opposed to JPN is the cost. JPM was going to be roughly around $8 and change per option. We were able to scoop up, gosh, gang, those of you that are in Sector Secrets, what did you pay for XLF? Again, as opposed to say $8 per option for the JP Morgan at the money call, I think 250, 240. Yeah, Lorna, 240. So think about how much more bang for your buck you get. And then how much broader your play is when you're actually betting on not just JP Morgan, but a lot of the relative outperformers within the XLF. So rather than betting on a stock, even though it's over 12% of the weighting, I have exposure to JP Morgan, but I also have exposure to Bank of America, Wells, Citi, unfortunately a little bit of Morgan and Goldman, unfortunately today, but most of these names are actually really strong and they should dilute whatever negative Morgan and Goldman are going to have. I believe that'll probably be fairly temporary, but yeah. So yeah, we shall see. Yeah, I'm long XLF. I don't know if you mean as a day trade, but end of day, we're already long XLF. You're already long XLF. So that suits me just fine. So the XLF, by the way, the XLF, do I like it intraday today? No. End of day, no problem. I mean, we bought it down here. So even where it's sitting at now is not a problem. It's still an unrealized winner, which is why using momentum and using pullbacks. Look, I kind of alluded to this in the charts and coffee, and this is such an important part of the market conversation. Yes, watch lists should be your number one priority, building watch lists. And we're building watch lists very different in March than we were in February and January. The next thing is getting the real difference between traders, activities, and success come down to time frame and time horizon. Timing. And I think one of the most interesting things is when you get down to it, after a while, you're going to have groups of traders trading similar things. Are there traders out there with watch lists similar to mine? Probably, because I don't think the reflation trade and avoid the broader indices is that unique, right? So you might say, well, aren't other traders kind of looking at the markets in a similar way? Always. There's millions of people in the markets. But the difference then comes down to time frame, time horizon, timing. So one person getting long XLF, and this is going to be most of what happened. Where do you think in the and this is XLF, corn, Apple, it doesn't matter. Within the context of movement, where do you think people got long? On the down blue candle or on the up green candle? And if you've been in the markets for more than, 2 weeks, you know that most call buyers will do so on the 25th of March, not on the 23rd or the 24th. Why? Because most traders are microwave brownie fans, right? We want what we want now. We want to feel good while we're doing it. And that means buying things as they're going up, right? Now, they did all right, but not as good as those of us that bought it on the pullback, where it's not as easy. Very different. So people talk about buy the dip. It's hilarious to me that seems to be the rallying cry in the broader markets because most people don't do it. They don't buy the dips. They're still buying the rips. Dip is the move lower, rip is the move higher. They're still buying the dip. So most people don't have the intestinal fortitude to buy the dip because they don't have a tactic that makes that dip what it is, which is a retracement. Why would a market stop here? What is evidence that the market would stop here as opposed to buying the rip? They somehow feel better buying something when it's moving higher, which is actually just a delusion. An expensive one at that most of the time. The only time that those folks are able to do pretty well is in a screaming uptrend, in a parabolic uptrend. But then everyone's doing well at that point. But I will say that buy the dippers struggle a little bit there, like myself, because the dips are very shallow and infrequent. And the folks who can just buy higher highs, well, they're rewarded for that. Does that make sense? And sometimes when I say that, it hits a little close to home. Because a lot of folks did that last year, and you can tell they were doing that last year because they're not doing so well right now. And so it doesn't mean that you can't shift gears, but please, what I'm trying to say is shift gears now. This is not 2020 parabolic uptrends where you can buy almost any high and be rewarded for it handsomely. This is not that market. In fact, you don't even want to be playing the broader averages that much. You don't want to, because we don't have the S&P, the NASDAQ, and the Russell moving higher, hitting all-time highs every 3 days like we did last year. The Dow is a little bit different, maybe not parabolic, but if you like that uptrending kind of movement, look at the places where you can still do it, which kind of right back to watch list building. Okay. How much do I think oil will pull back if OPEC announces an increase of output? SM, I have no idea until we start getting some, nobody has any idea really, except for maybe the folks at OPEC. If and when the cartel does announce they're going to increase output, it's two things, SM. One, what is the number? What is the number that the Saudis and the Russians, OPEC Plus, essentially will agree to? Is it that much different than what the discussion is about? So really, what we need to do to understand if it's going to be a pullback or maybe completely neglected, let's say they increase output, but not as much by what was expected. The market will move higher. Let's say they increase output by more than what was expected. The market will move lower. If it's as expected, well, there's no shock there because that narrative has been discounted into price. Yeah. So what happens with this, it's not a matter of what they do, it's what the market anticipates they will do. That's the game. So it's the consensus or the expectation versus the actual game. Most people just think it's the actual game. That's not true. Okay. All right. And great question, SM. What does ZS look like? Sure. So this is soybeans. Thank you for the question, Irene. What does ZS look like? I'm long ZS, and yeah, it's moving lower. It's moving a little lower, quite frankly, than I was hoping it would. I won't kid you on that, which would be really unfortunate. I've got a stop at 1371, so we're not near that yet. But at the same time, we've actually just moved down to where the moderate entry that I posted. Now, I posted this entry back on the 12th of March. So that means, and this is going to be similar to what I do in the mastery, that alert comes out the evening of the 12th of March, and you place alerts on your platform. So this morning, I got an alert, as I'm sure many of you did, as we crossed down through 1386 and a half. A little alert goes off. We made it all the way down to 1383. So a little alert goes off to remind me that, hey, with the bearish momentum, if I wanted to buy SOYB, or when we hit, and actually I had a limit order. So 1386 and a half alert was for SOYB calls. But as we traded down through 1386.5, my limit order gets filled. So I still like it. It's still within the range of those entries. I will say one of the things that's definitely happened as we've wrapped up March is some of these reflation trades have definitely taken a breather. All right, corn's doing fine, but they are definitely just sort of spinning their wheels a little bit here. The longer term picture for corn and beans is unbelievably bullish, but it doesn't mean that we're not going to have periods of time where the market just takes a break. And I feel like it's taken a break easily over the last month. So it's been, to certain degrees, working for us. All right. Our first upside target, which I really should remind everybody, in corn was 555, which we hit. All right. So nobody who took our corn setup, which was sent earlier I think we had a couple setups in corn, right? We had the CORN, and we also had the ZC. I think we've gotten into ZC. We actually rolled into ZC a few times. So back on the 3rd, we got into corn, 532 and 524, which never got hit, but 532 was hit numerous times throughout the month. And then it finally went up to 555. So nobody here should be at anything worse in the futures room, gang. Anything worse than a break even on corn. Not a great trade, but hey, it moved from 532 to 555. I'll take that, especially in a market that's kind of stuck in a range. And I will continue to look to the long side until we can finally break out, which we have yet to do. But we've got this formidable value area high volume resistance sitting overhead at 560. I think if we can take that out with the remainder of the position, if I don't hit the break even stop, then I can benefit from the next leg higher in corn, which I anticipate will come. From a macroeconomic standpoint, there's a certain inevitability about it, but it doesn't mean it just moves up in a straight line because we're in reflation, right? Macro principles, which are probably the most misused and mistimed, even misunderstood parts of the market. Macro is not timing, gang. Macro is not earnings. Macro is not even this Archegos hedge fund imploding. And yet I hear people just use the word macro because I think it makes them think they look smart. Macro is pretty simple. It is actually really simple if you know what to measure. Growth, inflation, monetary policy, money supply. Everything falls under those buckets. Most things that people call macro, unfortunately, is actually fundamentals. Individual stock fundamentals. Macroeconomics are those broader tectonic plates of economies. All right. And that's where I'm talking about the corn play and the crude play and this overall inflation in the grocery store commodities that you guys know if you've been following the free videos and, of course, the premium. um, they've been working. They've been in play. So, again, end of the month. This has been a very strange month of March. We're seeing a little bit of a breather, but I absolutely feel they will get back on track. Yeah, J Bottom, Natty Gas, I won't play straight up through the NG futures, but I'm with you. I think there's a lot of energies contracts that look very good. Natural gas would be an interesting position to build via UNG longer dated calls. See, if I were looking at, and I have been, if I'm looking at Natty Gas, I'm looking at UNG, which is actually a pretty liquid ETF to play this commodity with. And I would look at some longer dated calls. Yeah. So I think there's a bigger picture play, maybe back to the 200 exponential, but it can move dramatically, ruthlessly, very quickly. And so years, decades have taught me, usually with natural gas, exactly, Lorna, they call it the widowmaker for a reason. But I think the UNG calls are a great place to build a position, or even calls in natural gas. So I think if you've got something like Natty, I would not put a stop on natural gas. So most people do not do well with markets like natural gas because it is as volatile as it is. I would throw silver in there as well. If and when I do buy natural gas futures, I will use an option as a stop loss, okay? I don't do it often. I rather just buy SLV and UNG and sleep well at night. And there'll be large positions to accommodate the move that I believe would happen, and the bargain that I can get via those ETF options. But what I'll do if I ever buy NG futures, even SI, I will use the option as a stop loss. Talk about an elastic way to protect yourself. Talk about a heck of a safety net. Yeah, but nice trade on Natty. I think you're going to see more upside. Yeah, for sure. I'm thinking, you're looking long? Yeah, looking long. Yeah, I think that's a nice trade. Why do HPMRs move the price action before the next one's due to start? They're constantly moving, Sebastian. The HPMRs are constantly moving because they're being well, not constantly. Let me not get too dramatic, but they are moving according to new highs and new lows, and that's what they're supposed to do. So that little transition that you see there, that's basically moving from 1 hour to the next, because this is a study of the volatility from 1 hour to the next, the top of the hour to the top of the hour. So you'll see that adjustment start to prepare before we shift to the new hour. So there's 11 o'clock. There's your shift. I don't think they're adjusting before. If I'm not understanding the question, probably why do the HPMRs move by the price action before the next one is due to start? They move based on the high and low that is in the market at the time, and they add and subtract that volatility number. That's all. So when a new HPMR plots, it's got nothing but a minute or two it's actually looking at, right? Whatever that high and low is at the time. So a very, 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 very fresh HPMR is actually not as helpful as the one that preceded it. Yeah. So I like the questions on grains. Thank you so much for that. And let me grab a few more questions from the live stream here. Yes, Trader Mo. Yeah, I totally forgot April 1 expiration for this week's options because of Good Friday. Yeah. Exactly. We have a 4-day week. And that's another thing to keep in mind, gang. We have a truncated week this week. So Thursday is our Friday. Keep that in mind. So when traders want to wrap up their trades considering the long weekend, yeah, so just keep that in mind on Thursday. It is the Friday. It is where traders will consider the exposure that they want to keep going into the uncertainty of the weekend. And a long one at that. All right. How do I use options as a stop loss? So Dorothy, if I'm long a market, like I was talking with Jay Bottom about the long natty, I'll buy a put. I'll have puts. So instead of having something that gets me out of the market, what I'll have is something that increases value to offset the losses in my long position. It may not be a tick for tick offset, but it's something that's going to diminish my unrealized loss, give me a more elastic stop loss. So what I'm going to have is something that, as my, say, natty gas position were to lose money, hypothetically, because I don't have a long natty gas position, if it moves lower, the value of the put increases. I don't do it often. I only do it in specific markets where the volatility is high enough where I know it can shake me out before the validity might carry me towards the ultimate target, or if it's a very volatile market, like natty gas and silver can be. Do I do any swing trades in the futures room? In the morning on the mic, Prabish, I will do mostly day trading, and then after 10:45, 11 o'clock, we might look at some longer term swings. But here's the thing. So first of all, swing trading to me is trend following, typically on a daily time frame. I want to be in it for days, if not weeks. A la corn, a la British pound, soybeans. We've had a number of copper. These trades, in many cases, lasted weeks. And I'll usually take them on a daily time frame, which means we need, margin, overnight margin. We can also play ETF alternative options and options on the underlying futures. I mean, those are all viable alternatives, but they're longer term, again, days to weeks. And so that I'll usually cover. Sometimes we'll cover it in the session here, but I do those in the premium video. So every night I record a premium video. I spend an awful lot of time talking to this microphone sitting on my desk here. And one of the things that I do is I record about a 15-minute video that's available to members where I discuss, sometimes I'll recap the morning price action, things like that. Sometimes I'll discuss the environment that we're in, as I have been quite frequently in the premium video. And then often there'll be setups for longer term commodities trades. But the thing to remember about commodities, unlike stocks, one thing I was just talking to my husband about over the weekend, it's interesting. Being a scanner of stocks is just a lot more time intensive because there's just so many darn stocks. I've been trading futures and Forex for most of my career, at least the last 20 years of it anyways. And then before that, it was more a mix of day trading and stocks the previous 10. But the last 20 years, it's been focused on futures and Forex. And look, in the Forex market, there's maybe 10, 12 viable pairs at any given time, depending upon the currency's strength and weakness contrast. And then in futures, it's not much more than that in terms of front month contracts with decent open interest and liquidity. So usually I could scan easily less than probably 40 to 50 symbols, and I was all set. To say that on the stock side, I'm scanning upwards of 200. Yeah, so scanning in the futures and Forex world is a lot more finite, and I love the compact nature of those markets. But on the flip side, when I do the sector secrets, I'm scanning dozens and dozens and dozens and dozens of stocks. And then when we leave a correlated environment where I'm not that interested in names that are tightly associated, weighted tightly with the broader averages, now that list actually grows because I'm not limited by what is tethered to the S&P, NAS, Dow in those sectors. Now I'm even moving outside of those. Not only am I still looking for relative outperformers in some of those sectors, but now I'm looking for relative outperforming sectors and stocks within those that are, as really in many ways, at arm's length from the indices, which is, by the way, what has been working. That's what's been working. And yeah, I see some of you talking about the meats. Absolutely. We actually played cattle, which was a great trade, live cattle, and then lean hogs have been on the radar. Absolutely. last night I had barbecue for dinner, and we were talking about the price of meats. And as the grain prices go up, as the fuel prices go up, inevitably we're just going to continue to see more and more inflation at the grocery store. But as one of my mentors reminded me a long time ago when I was long coffee, and I was telling myself, oh my gosh, my cup of coffee is going to be more expensive. I said, yeah, just stay long the commodity. You won't care. I'm like, oh, good point. Good point. Henry, yeah, I think hey, Lorna, are we like 16 for 19 or 7? We got stopped at a Freeport McMoran. We got stopped at a rig. What else we got stopped at, Lorna? 17 for 19, either 16 or 17 for 19, Henry. Yeah, we've had 19 setups, including XLF. That was the one from last week, since February 25. February 25, we started focusing away from the broader indices. I think our first 2 trades were, okay, heck with this broader indice thing. I got rocked by I ended up having a really good February up until mid-month and gave nearly all of it back. And then the end of February, around the 25th or 26th, I said, hey, let's forget this whole making money the first 2 weeks of the year, month, and then giving it back the last 2 weeks. As you've seen the volatility, we've seen crazy volatility the last 2 weeks of January and the last 2 weeks of February. You can see that in there, right? And being tethered to the broader averages hurt. I'd make money in the beginning, give it back at the end. Did it twice, 2 months in a row. Until finally, the end of February, I said, heck with this. The reflation signs are there. There's emerging strength in sectors and indices that have nothing to do with the stinking S&P and NAS. And let's focus there. And the first 2 trades we fired off as we shifted were long Toll and KB Homes. Yeah, I said, all right, NAS, S&P, I'll talk to you later. And we started shifting. Yeah, we started shifting. It might have been 16 or 17. I can't remember off the top of my head, but Lorna says 17 for 19. All right, so I'm going to go with that. But again, it's not that the market suddenly got easy to trade. We focused on markets that had better structure. Yeah, so that's really important. Hey there, Agile. Any recommendation on how my 10-year-old daughter can learn futures trading? She's trading with me. It's made nice profit. Oh, I love that she uses to buy Roblox. I love it. See, now you're hitting my soft spot, which is I love when folks, golly, I thought I was young getting into the markets when I did. She's got me beat. I love when kids get into the market because they do it better than we do. It's just colors and trends, and they don't have all this. Well, the fundamentals, no. Well, this hedge fund, no. They just trade what they see. They're smarter than us in that regard. And I love when they get into the market. So futures trading, I mean, stick with the trends, Agile. I think to be a commodity futures trader right now is going to be great. Stick with the trends. There's a lot of micros. I would say, now, granted, she's starting 5 years before I did, but teach her a handful of patterns, maybe 2 or 3. Enough where don't teach her one, because then she's going to see that one everywhere because there's nothing else to do, right? Teach her 2 or 3 patterns, and then just those 2 or 3, and just have her wait until one of those occur. That's what I would start with. Let me put some more thought into that, though. But that's the broad stroke. 2 or 3 patterns, and don't limit her to 1 or 2 markets. Maybe limit to markets that have reasonable overnight margin. Maybe limit to markets that have micros and minis. That was one thing I was very lucky to have done when I first started my commodity futures trading, which is I traded grocery store commodities, and I could trade corn for $400. I remember my initial margin was $405. I could trade cocoa for about $500. So there were a lot of inexpensive grocery store commodities that did not require a lot of margin. So if she's trading micros, yeah, that's awesome. Yeah, it's currency micros. There's quite a few. There's gold micros. That's awesome. But I would say find a few patterns, teach her those, get her really good and disciplined at finding those, and then you'll just keep adding. But if you get her disciplined early on, and with kids, funny enough, they're better about it for sure. But yeah, get her started on those and then go from there. What other questions do we have here? Is TradeStation a good platform? It depends on what you want to do, one, two, but yes, I think it's a good platform. I do. Hey there, Mark. Let's see. You learned futures and spot through osmosis. I learned spot from the, it's funny, my Cleopatra baby pips personality. Oh, that's hilarious. I loved writing for baby pips. I really need to get back to that at some point, but I just started running out of hours a day. And then you got a mentor from Chicago, legend. That's awesome. That's awesome. Order flow trading. Wine tube. Okay. If you're going to do that, yeah, that's a whole other conversation. If you're going to do that, I mean, I don't know if you want to just commit to that and just straight up start going market profile and use something like, oh gosh, I'm totally drawing a blank. Just get into a market profile platform. I will tell you that Ninja, I believe, Ninja charts are probably pretty good for that. Now, order flow is just another way of talking about, talking about market profile and volume profile. I'd say volume profile even more. And you're looking for those D and P and B-shaped profiles, things like that. I think you could probably do that even with some of the plugins from TradingView. But as far as I know, yeah, you're probably going to be looking at like Ninja 8, probably for something like that. So no, I wouldn't say for TradeStation, that's going to be your best bet. I would say probably TradingView. Like, let me show you my charts on TradingView. These aren't perfect examples of what I'm talking about, but you see I can pull those volume profiles. I pull multiple, so if I want to look at those P, B, D profiles, I can. I do believe there's some more order flow plugins that are available. I just don't have a lot of experience with them. And then I would say probably Ninja. Okay. All right, gang, we're winding down here. I was going to give you a break, but I'll probably just wind down here and give you guys a little bit of a break before David gets here. And thank you so much, those of you that are in the room live with me the last 2 hours, and you're probably with me for charts and coffee. So thanks for spending the morning with me. I really appreciate it. Thanks for the time. I hope it's added another nuance to your overall approach, understanding what the markets are doing. And, on a day like today, sometimes realizing that you don't have to trade your face off. And it's okay, as I like to say often, that it's okay to give your keyboard and your mouse a rest and not risk over trading. Right? That's a standing order anytime that I'm in the room. I'd rather you be flat than regret you took a bunch of trades and made your broker rich that day. I have nothing against my broker, but they are not a charity. I think some people trade like their brokers are some sort of charity that they want to contribute to. I'm sure your broker's happy about it, right? So just some long side trades off the low end of the range. We are getting through the European close right now. And by the way, gang, if we're going to start to move higher, it's probably going to start during the doldrums after the European close and off these V-score lows. But what have I done? I've bought some calls that expire Thursday for very, very low cost, liquid market, 15 to 25% of what I paid for the premium risk, no more than a risk of 5 to 7% of your overall account, which I'm well below. and I'll see if the market's going to rip higher. And because I know that my worst case scenario risk is I lose what I paid for the options, which I'm nowhere near going to risk, but I know that's my absolute worst risk. I can sit through a lot of this pretty well calmly, right? But if I had the underlying futures, probably not, especially in the double red environment. And notice how the markets have gone yellow and how choppy they've become. We haven't gone double green yet. If anything's going to lead the way, gosh, if the NAS would lead the way, that would be spectacular, because the NAS is tech, and tech has weighting across S&P, of course, NAS and Dow. So, but I'd like to see these start to recover from their V-score lows, and in some cases their HPMR lows and their value area lows. And I've just got a handful of options, well, more than a handful, but I've got these options that I've bought in the ETF alternative. And some of you might have micros, but I'm long. That's it. I don't think there was a short to be had down here. I'm just long. And I'd love to see the markets move higher from here. I think that hedge fund news, way too much was made of it. I think way too much was made even more so off Friday's rally, which I hope you guys will learn. Anytime folks start blaming algos on the way down, and they never give algos credit for the way up, why do we say algos or systems, or I just call it Skynet? When Skynet drives the market lower, we almost want to dismiss that move lower or the losing trades to, well, it was the machines, right? And yet when the market moves higher, you never hear anyone on financial media going, well, guys, it was the machines, right? So up moves are always legit, but down moves are always the machines, right? Didn't you love that? It happens so often. Gang, it goes both ways. It goes both ways. And unless a move to the up or down side takes out significant, say, swing high or swing low, unless we're going somewhere new, it's my little puppy stuck in the yard, just running back and forth after her Kong. Right? That's what happened Friday. So I'd love to see the markets move higher. I'd love to see the Friday swing highs taken out. Even more so, I would just love for this market to reach the value area highs, because that would actually put my options at a decent profitability. I can call today, put today in the win column, and then I can embrace what is a day trader's bestie, the next session. There's always another session rolling around. So gang, I will see you all in the futures room tomorrow morning for the open. All right. And folks in our live stream next Monday, we'll have someone else broadcast. It should be every Monday. Someone will be there. And then let's see. David's up next. In fact, David's up right now, Mr. David Starr. So let me get out of the way. Everyone have a great one. Thanks as always for taking time to join us. Feel free to join us in our Simpler Futures room. I think if you just go to simplerfutures.com, it'll take you to the URL that the trial offer is at. And if you want to join me for my ETF and stock options trading, the mastery, you can join me at simplertrading.com/sector. And I'll be doing that today. So if you join up today, you can join me for that 3 p.m. recap and rebuild session. All right, gang, have a great one. Be good to each other. I'll talk with you soon.